back to the TBC Blocktalk, where we, the TUM Blockchain Club, a student initiative from Munich, talk about blockchain and its opportunities. Today we have a special guest with us. It's Julius Nagel. Hi, thank you that you're here.
Yeah, glad that you guys have me.
Can you introduce yourself?
Sure. I'm Julius, actually from Munich, so and studied at TUM. So I'm happy to see that you guys are having this club and this initiative. I was also attending the conference last year, so I know a little bit about the TUM Blockchain Club. My background is in economics and business, and I got introduced to the whole crypto topic quite early on. In 2012, I discovered Bitcoin for myself. I don't really remember why. I don't know. I think I was reading about it. Back then it was Silk Road and all these use cases. But I was kind of fascinated by it through my economics background, reading about monetary policies and monetary theory. And so obviously Bitcoin was something of interest. And then quickly fell down the rabbit hole. So many started investing a little bit. I was lucky enough to get introduced to the Ethereum team very early on in 2014.
How did you meet them?
I didn't really meet them. The YouTube algorithm was kind enough to suggest a video where Vitalik announced the Ethereum white paper the first time publicly at a Bitcoin conference in I think it was Miami or something.
Mm-hmm.
So I saw that video. And I mean, still, if you see Vitalik speak today, you probably need to rewatch the talk 2 or 3 times to really get the whole idea, just because it's such a high density of information. And he talked about smart contracts and so many new things, which back then were kind of revolutionary. So I was intrigued by that idea. It was very intellectually interesting question. What are smart contracts? I mean, we have Bitcoin. Why do we need something else? Mm-hmm. But I started reading more and more about it. Obviously, I'm not very technical from my background, so I didn't understand everything. But I kind of understood that, okay, this is an idea where we can do more than just transfer of value on a blockchain, and there's endless opportunities. And it's interesting to see from today's point of view. Back then, there were already these early blog posts from the Ethereum community about things like NFTs, prediction markets. So it's actually really interesting to see if you look at Polymarket today or the whole NFT space, which obviously has grown tremendously, that those ideas were already thought of back then. This is kind of how I got introduced, and then I actually reached out on Twitter to Michael, who was one of the, I don't know if he was a co-founder, but one of the early core Ethereum guys. And he actually, a fun fact, I don't think I've ever told that story. He actually invited me to Zug to kind of join they were all working from Zug in Switzerland. Yeah. I never did that because I was interested, but I was not I was studying at the time and doing other stuff, so it was not a fully crypto nerd yet at this point. Because even back then there were these people that said in 2012 Bitcoin's going to revolutionize everything, this is digital money and so on. I was not in that camp, but I was intrigued enough to start working with them in a sense where I was just part of the core community. There was Skype groups back then.
What did they do? What was the topics there?
It was so most of the discussions were technical, how should we develop the clients, and Gavin was still drafting the yellow paper and so on. But there was also these things of, okay, how can we get more into the community? How can we go to Bitcoin meetups, talk to enthusiasts, blockchain enthusiasts, and so on. And so this is kind of where I supported a little bit. I organized some of the first meetups. And just was involved a little bit. I was curious. I wanted to learn. I felt like I'm the dumbest person in the room, and that's usually a good thing. Yeah. And so that kind of kept me up at night in the community calls.
Oh, nice.
Yeah.
So how many people were at these meetups?
Not a lot. I remember I did a meetup in Hamburg once. It was a Bitcoin meetup. There were 20 people, and I kind of pitched Ethereum to them. And yeah,
I a non-technical person as well.
So and then also the Bitcoin community back then was very hardcore in a sense, and so many people didn't like the idea that we need a new blockchain. But yeah, it was cool. Kind of lost track with blockchain a little bit during my masters, where I was just like focusing on other stuff. But then like 2016, when I thought there was like the first projects building on top of Ethereum after the launch, and then obviously 2017 when prices started rising, which came as a surprise to me at some point. I thought, okay, I really need to like go deep on this stuff, and at the time I was already doing my internship with McKinsey, but I spent I think like at least as much time working as I was doing like crypto research and figuring out what the next thing is, and so yeah, over the years just stayed around, basically watched this small industry evolve into something big.
Yeah, no, it's bigger. I mean, it's still growing. I think there's a lot of potential
hopefully
left. Yeah, and you also started heavily investing in these kinds of projects as well, right?
Yeah, I think it comes naturally. I think like crypto is this thing where like if you're interested and intrigued by something, you actually have the ability to invest. Like let's say you are, I don't know, interested in some AI stuff a few years ago when not everyone was talking about it. Like it was not very easy for you to invest. Obviously, like you needed to be part of like a venture fund or something. So with crypto, it was very open always, and you always were like this user, but you were also an investor, and you also were just like part of the community. So I think investing was just like came naturally. But obviously, like prices kind of exploded over the years, and so yeah, you invest more and explore different ideas, ICOs in 2017, a lot of DeFi stuff in 2019, 2020. So yeah, I've seen very many like different things come and go over the years, but overall I managed to not get like wiped out or anything. Managed to stay motivated. So there's a couple of things. Some people could just get wiped out and lose everything. Some people just like lose motivation and move on to other things. And so yeah, I kind of stayed within the space. And yeah, invested in a lot of things over the years. Obviously, a lot of things went good. Some things do not exist anymore, or I mean, the tokens like trading at ridiculous prices. So a lot of learnings. And that's also something where I'm so grateful for the crypto space as an investor, because if you invest in other asset classes, like let's say stocks or real estate, I think it takes like 10 to maybe 15 years for you to see like a full cycle, you know, like price appreciation, maybe some hype, and then like a sell-off or something. And with crypto, you have that like historically every 4 years. So, you know, I've been in the market almost 12 years, and so I've seen like 3 full cycles by now. And like looking back, there's so many things that you learn, just like managing money, but also like from investing, your own personality, your own like biases towards certain things, because we all have biases obviously, and you know how your emotions change when your portfolio does like a, I don't know, 500x and then it pulls back 50%. Like how does that make you feel? So there's so many learnings that it's actually, I think, the thing I'm most grateful for.
It's super interesting. Yesterday we talked with 2 founders actually also about like the market changing in crypto. So like the crypto winters and how you should behave as a startup, like having like building your product within the crypto winter when you have time where not a lot is going on, and then when the bull market comes again, you're trying to get the money and the funding. Yeah,
I mean, as an investor, I think it really pays off to be like kind of anti-cyclical. So when everyone's talking about it, like you probably should lean back a little bit and vice versa. But it's a hard thing to do. Like and you learn the hard way. Like you do make mistakes, obviously, but I think it's good. Like you learn from them, and you know, I'm happy. I'm still in my early 30s, and I've seen like 3 crazy cycles, and so I hope to see many more cycles in my lifetime within crypto and in other asset classes. But investing is like a very interesting intellectual challenge also to me, so I want to continue doing it. So I hope to sort of be prepared for many other things to come, because like, yes, everything moves different and there's different asset classes, but like the human in the loop is the thing that doesn't change. And so like emotions and like fear and greed, I think those things will repeat over time.
Yeah. And now you have your own fund as well, with Wave.
Yep.
Learning more there, I guess.
Yeah, we just recently announced that. So with Wave is a liquid fund. I think we want to talk a little bit about liquid token investments today also, which we recently announced, and where we're building a portfolio of tokens. So we're managing external money and want to offer investors a access to this asset class first of all, but also access to sort of a portfolio of tokens which offer a little bit more performance than if you would just hold Bitcoin. And obviously through our experience, our know-how about the technology, about the space, but also about investing in general, I think allows us to pick hopefully the right tokens and generate awesome returns.
So it's quite new, right?
It's quite new, yeah. So we just announced it. So we're now recording end of June. We announced it 2 weeks ago in Berlin, and we will launch it officially in the summer.
In summer.
Yeah.
Nice. A lot of work until then.
Well, let's see. Talking to investors, talking to lawyers. But the thing is, like, for us, so I'm doing this together with a partner, Philip, who's also been a long-time investor in crypto. And so for us, the good thing is we know the space, and like for us, the things we've invested in the past with our own money is very similar to the things we want to invest with the fund from a strategy point of view. So like how we invest from day one is like we already know that. So it's more about like setting everything up, communicating it properly. It's preparations, but it's fun. It's fun work.
So you're also staying in Berlin?
No, I'm in Munich. So the fund is officially in Berlin, but I'm located in Munich.
Nice. Yeah. So maybe you can tell more about the liquid tokens. What is it?
Yeah. So liquid tokens. So it's an interesting concept if you know the venture space, like venture capital, and generally private markets. What you usually see is that companies, or there's like a team of builders that have an idea, entrepreneurs, and they sometimes need some external money to sort of bootstrap the whole company. And usually you raise from angels, like a pre-seed, and then for sort of as you grow, you raise from VCs, seed, Series A, Series B, and so on. And then at some point, you have a liquidity event. A liquidity event means either an exit, like another company buys you, or you go public, IPO, which is a rare case, but usually like only the most successful companies do that.
And that's also the same for the Web3 space, right? You can apply that to
space. Yes and no, and this is the interesting thing. Like in the crypto and the Web3 space, you have liquidity events way more often and way earlier. So this is where the whole liquid term comes into play, because there you're right. You have the same like entrepreneurs that have an idea. They sometimes raise venture money. But the end goal for most of these companies is to become like some sort of decentralized protocol or application. And in order to get to that point, they need to decentralize. And so they usually launch a token, which is can be thought of as a sort of equity in the protocol, or like a part of like ownership in the protocol. But this decentralization usually takes place quite early on in the life cycle of a company. So usually you have like a seed round, Series A, maybe Series B, and then you launch a token. And so it's still like very early stage companies which now have like a liquid tradable token on a secondary market. And so this is when we refer to liquid tokens, this is what we talk about. So we invest in tokens on the secondary market. So that could be something like Bitcoin or Ethereum, but also obviously the long tail of assets like less known projects, which we think might be interesting as well. And so this is a very unique aspect of the crypto market because you have this early liquidity. So for investors, this means access, first of all. So access to companies that otherwise would stay private way longer, which is a good thing. But it also has some challenges because these super early stage companies, maybe they still haven't found product market fit, so they're still figuring out their business model and everything. And now you have to value them, right? There's a market. So the good thing about venture is like VCs do these valuations, but like often when you talk to VCs, like, hey, how do you value the company? It's like, well, all the other companies are valued at this level, so we're just going to do like a Series A at, I don't know, 30 million, 40 million pre-valuation. That's just like the standard, but no one's saying like, okay, this company is now worth 30 million today, right? But once these companies become liquid, there's a day-to-day market, and in crypto is 24 hours. So investors need to think about, a certain project at a certain valuation? Is that too high, too low? How should I think about valuing these tokens? And that's a very hard task at hand because you don't have a lot of data, right? So it's still like early stage companies. They might have some revenues, but is it really like a sustainable business model yet? Probably not. So to give you some examples, like what is like an Arbitrum worth today? Like it's hard to say, right? And that's why you see the volatility. That's why you see the volatility in the market. And this is sort of the pros and cons of liquidity. I would say pro is it gives you access, but the downside is you need to think about valuations. And I think this is where a lot of the volatility in the market comes from, because different market participants have different expectations about sort of the fair value of a token. And so until we find some equilibrium, it usually is quite volatile. And for many market participants, this can also be like a downside, right?
So how does it work? How do you what's the process? Where do you start?
So I mean, for us, you can start, I think, at different. You can look at it from different angles. So for us, obviously, we know this industry, we know the technology. So for us, it's more about, okay, what new technology trends do we see? What new business models do we see that we think are interesting? And then it's a lot of research. So reading, talking to the team. So what are you building? Why do we need distributed validator technology, for example? Can't we just do staking the way we've done it in the past, and so on. So it's obviously it's understanding technology trends and business model trends, new applications. There's a lot of innovation in the place. But then when it comes to valuing these things, I think you need to understand what are drivers of value in tokens. Because as I just said, you cannot just be like a Warren Buffett and say, okay, I have the cash flows of the past 20 years and I know the profit margins and I know how fast it's growing and I have good industry comparables, so I can just say, okay, this token is worth $2 because the numbers say it, right? It's way less of a science and more of like knowing what influences the crypto markets. And I think once you realize that, you obviously think about, okay, what are these value drivers? And I think there are many different aspects. Some more come within from the crypto ecosystem, and some are more external. So external, for example, is like macro. So obviously, crypto is dependent on liquidity, is dependent on like external factors like central bank policies and so on. Like any other asset class, crypto has exposure to it. And you've seen these narratives in the past. I don't know if you heard about like Bitcoin is an inflation hedge, crypto is correlated with stocks, tech stocks, and so on. Like, I think all of those are true to an extent, but we've never seen these like correlations hold up over time. So I think it's not as easy as that, but I think you need to be aware that macro is a very important factor. And then like other things are more crypto native, like understanding the tokenomics. Like, okay, how much inflation is there? How many unlocks are there, for example, in the future? Because one thing that's different to stocks, for example, is with the stock, usually you don't have like crazy inflation. Like you have some employees who get new shares issued, but besides that, there's not a lot of inflation. With token, it's very different, right? Like there's the team, the investors, the early investors, they're all unlocking the tokens, which sort of has an impact can have an impact on the price. Beyond that, obviously it's technology modes. Like, okay, is this technology better than another technology in the market? Like are ZK rollups better than optimistic, and maybe that drives price. And is that mode actually sustainable? Because in crypto, a lot of things are open source. So if you remember like the sushi swap fork of Uniswap, I think people realized, okay, maybe the mode is not just a tech, maybe it's more like liquidity or community. So I think you have to think about these different factors that sort of differentiate one project from another. And then beyond that, it's obviously also fundamental. So one thing about crypto that makes crypto unique is that most of the data is stored on the blockchain. So it's accessible. You can, if you know how to access it, and there's good providers by now, you can work with it. And you do not, like as an investor, you do not have to wait for a quarterly reporting of a company, but you can just go like on chain, query the data, or like use a Glassnode or token terminal or something, and update your dashboard every minute, and okay, what's the sort of the transaction fees that Ethereum has done in the past hour in real time.
Cool.
It's a cool feature, right? In the thing, so then you have all this data, but then the question is, okay, can I actually value Ethereum based on like historical transaction fees and some price earnings multiples or something? And there's a lot of investors that are trying to do that. So they try to use like traditional financial modeling to value some crypto protocols. I'm personally not a big fan of that because I think we do not really know yet what drives value. So, is Ethereum valuable because it has a lot of transaction fees associated with it? I would say maybe, but also not, because now you have all these layer 2s and they're going to lose the transaction fees over time. So does that make Ethereum less valuable? I don't know. So I think it's more about like understanding, what drives value. So economic activity, like this term of MEV, moneyness, which is a fuzzy term, which is not really well defined, I think. But there's different value drivers. And as long as we don't really know what drives value, I think using like a discounted cash flow method is not the right tool to value these things. Like it can be helpful to get an idea of like where you stand, but I'm more in the camp where I think we need to constantly like monitor the markets and learn how people value these tokens. And it's also like valuing like an Ethereum, like a Solana, which are like these layer 1 ecosystems, versus valuing like some DeFi application is something totally different, right? The one thing is like these has very strong network effects. It's like this economic hub basically. And the other things are very concrete business where like I'm a lending market. Well, okay, like I have like lenders and borrowers and how much volume am I doing? What's my take rate? So it's a more easy business to model. So yeah, I think one of the big problems in the crypto markets is that you have these websites like CoinMarketCap and CoinGecko where you have all the tokens listed underneath each other. And to me, that's just like fundamentally wrong because like,
why?
No, because like we compare Bitcoin to some DeFi application and it's completely different things. Like you cannot compare these things just like based on a market cap. It doesn't make a lot of sense. So in my what I want to see in the future is like a website where you can just like you have different lists for different things. Like you can compare maybe Solana to Ethereum to an extent, or to like a Ethereum layer 2 or like a Near, or I don't know. But I think Bitcoin is its own vertical, to be honest. I think like I wouldn't even compare Ethereum to Bitcoin. Like to me that doesn't make sense. And then also like you have all these applications which should have their own benchmarks, and you shouldn't think about like this list of tokens and who's in the top 20 now. Like that to me is just fundamentally wrong. But everyone has learned over the years to use these websites. So you have these discussions about flippening and so I think like, maybe it's already too late to change that.
I have 2 questions. You talked a lot.
Sorry.
Super interesting what you're saying actually. Like the first thing, like we talked yesterday as well, like the market somehow always correlates, or I don't know if it correlates, but somehow the Bitcoin prices always like seem to adapt kind of. I don't know if it's this way around or the other way around. So don't you think this is like Bitcoin prices still, I mean obviously comparing DeFi projects with Bitcoin is not easy, but like somehow can you not
you mean like Bitcoin is like an important
market
value driver because everything's correlated?
I don't know.
I think so. 100%. Like I mean, the thing is, in crypto we always talk about like historically, like historically it's 10 years. Like what are you talking about? And so I think these things change over time. And now you have Bitcoin ETFs and people are arguing now everything's going to change. We don't have these like 60-70% dumps anymore because people are monthly buying Bitcoin as part of their savings plans or their pension plans. But historically, it's true that sort of Bitcoin has kind of led the rallies, and there's a pretty high correlation. But I think it's not that easy anymore because in 2017, for example, like going back a few years, like you could monitor the whole market like as a one-man show or one-woman show, like no problem. Like you had your CoinMarketCap and there was like a few hundred maybe projects, way less if you talk about the relevant projects. Now today there's like thousands of tokens, and what do I know how many DeFi projects are starting in like the StartNet ecosystem and in Sui or whatever. Like there's so many different ecosystems, there's different verticals. Like there's DePIN is a new like business model, and I think some investors are really good at identifying what are value drivers in DePIN. Others are good at identifying value drivers in gaming and so on. So you cannot really monitor this market, and it's growing so rapidly that I think just boiling it down to like, everything's correlated with Bitcoin. I think while it's still true to an extent, I think that will go down over time, and hopefully, hopefully the space matures and we can think about, okay, there's Web3 games which are doing well and which are then correlated to gaming stocks, maybe, because like the whole gaming industry like goes down, up and down together, but maybe it's irrelevant if people are buying digital gold, which sort of is Bitcoin, maybe.
Yeah, that's a goal to get to the market, I guess.
To get there, yeah.
Yeah. Oh, how long do you think it will take?
I mean, I think the pressure is increasing. So you have two different interesting developments, which are kind of counterintuitive. On the one hand, crypto has grown into an asset class. Like, there's institutional demand for Bitcoin, but also if I talk to like family offices, they hold Solana, they hold Ethereum, and so people are fine with investing in these assets, which is already a big step forward if we talk about where we're coming from. Like, this is just like money laundering, like all these things. At the same time, if you talk about blockchain adoption as a technology standard, I think we're still in the very early days, and there's this like meme almost like we're still early, right? But I think, over the years, the pressure is increasing where actually like we need to move beyond that. And we need to, like as an industry, prove that the technology is useful and there's like meaningful adoption. And I think you can see pockets of that, like stablecoin, for example. I think like stablecoin volumes are increasing heavily also during the crypto winter now. And so there's really signs of like adoption and people that want to own stablecoins and want to use it. But beyond that, like if you talk about DeFi, I think DeFi also is sort of halfway there. It's kind of established. But with many other use cases like gaming, for example, like while I think it's interesting, I still haven't seen a lot of proof points that Web3 gaming is meaningful today and really like changing the industry or anything. Like, I'm not saying it's not going to happen, but like just like looking at it today, like, yeah, you can own your assets, but like if like you ask 1,000 gamers and 999 tell you like I don't care if I own my assets, maybe that's also something you need to think about. So so going back to your question, how long will it take? Like, I don't know. I think we will learn over the years where blockchain is actually like a useful technology enhancement and where it just like doesn't make sense. But as long as there's a lot of money to invest into these projects, I think also, it can take a longer time until we figure it out, because companies have money, they can try new things, they can iterate and build more products. But hopefully in 10 years, if we talk, we'll know more about it.
2034.
2034.
Oh. Let's hope. Yeah, cool. Just coming back, I had another question earlier as well. The value drivers that you talked about, like which ones are the ones that you find important and which do you highly value? Like what's that thing?
Yeah, so I mean, I also think it changes over time. Like right now, currently, I think crypto is very much like macro dependent, just because like there needs to be, the industry has grown, the asset class has grown to a size where you need like liquidity inflows, also because you have all these token unlocks and so on. So you actually need like new money coming into the system in order to sustain price levels. So that is dependent on many factors, but like macro environment as a general theme, I think is very important. In the extremes, I think also just like investor sentiment as a general is very important. Like crypto, if you look at historic price charts, it's like super volatile, and you always have like these spikes and then like these crazy sell-offs into like times where everyone is saying like crypto's dead. Like I've seen this so many times, right? And so this is driven by investor sentiment. Like obviously, I think like the natural evolution of the technology is driving prices up and maybe down a bit. So you have like these natural adoption cycles. But then if you add on top of that like greed and fear, you have these crazy euphoria and then sell-off. So I think you need to be aware of that and need to know where you are in sort of this cycle. And beyond that, I'm a big fundamentals guy, so I spend a lot of time, looking at data, looking at adoption of different projects, how many users do they have, how much volume do they do, and so on. So to me, this is probably the most important factor in my research to know which projects are actually like meaningful and will likely survive over the years. But it's not the most important factor if you talk about price action. So I think their macro and like investor sentiment are way more important.
So how do you know if a project will last long, prolonged,
Well,
or is valuable in terms of like, is it numbers of users already, or?
So I think you need to. So I'm happy. I'm very grateful that I've spent some time in the venture industry and sort of I've learned how venture investors are thinking about projects and sort of how you do your due diligence. And a lot of it is about the team also. So talking to the people that are actually building the project. And I think that's super important also in crypto. So if I take a look at certain projects, I always want to like get exposure to the team and talk to them, because in the end, like, you know, let's not kid ourselves, like even though there's a token, like yes, it's decentralized to an extent, but there's still like a core group of contributors which are sort of pushing the thing forwards. And usually it's like a handful of people responsible. So if I think those people have like a big vision and have like the execution to actually do it, that makes me, you know, confident to invest also in a group of people. And beyond that, I think, yeah, it's users. It's like, it depends on where you are in the stack. So the lower you are in the technology stack, the less like user-centric it is and the more like developer-centric it is. So maybe Solana is a good example, right? Like after the FTX crash in late 2022, you know, everyone said, okay, Solana is dead, you know, it's not going to recover from this. And I thought this was a very wrong assessment, because I've talked to developers before that sort of built in the Solana ecosystem. And you know, if you talk to these people, they tell you like, no, this is like, I don't want to build anywhere else. Like this is where I'm going to build, and I don't care where the price stands today. I'm going to continue building here. This is an interesting data point, because then you think about, okay, if there's like this really core group of believers here, maybe they can make it to push this thing through. And sort of now, obviously 2 years later, we're a lot smarter and we know that this worked out. But so those are interesting data points, like active developers, TVL. Maybe, but I think like TVL, so total value locked, is a sort of a bad metric, because liquidity is, you know, very liquid, and sort of in crypto, liquidity usually follows the incentives. So if you have like a new chain coming out and they have crazy incentives, like everyone will put their liquidity there, and then maybe you think, oh, this is an amazing project, but not really. So I think liquidity can be misleading, but I would rather, yeah, look at active developers, active like users, growth metrics. So those are some of the numbers which I think are quite interesting and meaningful.
It's interesting. I mean, also the point that you said, like even if the tokens are like the valuations go down or something, there are still believers working on these projects. So how do you think like these correlate the product itself of a company and then the tokens? I mean, if you look at companies like Web2 companies, they have stocks, for example. Do you think there's a correlation between like stocks and the company, same for tokens and the company, or the Web3 company then?
Like you mean that you need to incentivize people by issuing stocks, or?
Yeah, like is that like the tokens, like what kind of how do you say, what impact does it have on the company itself if they have them, like?
I mean, so this goes to the whole point of tokenomics. Like how do we even design a token, which is also interesting scientific challenge. Like, yeah, I think we've tried. I think it's very much trial and error. Like over the years, so many different token models have been tried. Now we know that 95% of them don't work or don't work very well. So, you know, every other year you have like a new tokenomic design coming out, and people are playing around with it. And I think over the years we learn sort of more and more what works and what doesn't work. But like one thing is very important is that tokens, and this also goes back to this early liquidity, which we, you know, started out the conversation with. Early liquidity allows you to incentivize people, right? Like as a startup, you can give some shares to your employees. The problem is they cannot do anything with it. Like, yes, I have, you know, in Germany, ESOP in some company, but you know, what does it help me? Like, I cannot sell it, you know, unless this company goes public or something, usually. And now with a liquid token, you can give it out to developers. Like you can do like a grant program, for example. And people can actually use these tokens to then, you know, sell them on the markets and finance their daily lives. Or if they're strong believers, they can hold them. So I think a token is can be a strong driver of like a core community. But obviously it really depends on how you design the token and if it's done the right way. I mean, there have been examples in the past, like I think Polygon had like a huge grant program where they gave out a grant to game developers, for example. And I know people that sort of applied for these grants 10 times with 10 different games and got 10 times the grant.
Okay.
And so obviously these systems have to be designed in a meaningful way, and you cannot just give out your money for free, like your token for free, because people are going to sell it, and that can create this like spiral of like token price going down. And obviously, like if I only have a limited number of token, then I can give out less money in dollar terms, and then people are less interested in the ecosystem. So it can create this dynamic, but I think overall having something liquid to incentivize people is a very cool thing. So yeah.
Super interesting. I mean, I know it's a huge topic, token design, but
yeah.
Can you maybe just shortly explain like what's the best design in your opinion? Maybe only like a few points. I know it's a huge topic, but what's important?
Yeah. So I mean, there's many different aspects of this. So we can talk about sort of how you should launch a token, and obviously this touches the whole idea of airdrops, and how to break up the pie. Like if you think about, okay, there's 100% of tokens, you can have like this pie chart. What percentage goes to the community? What percentage goes to investors? What goes to the team, to the foundation? And so I think we've seen a shift this cycle towards a little less for investors, a little more for airdrop, a little more for like the foundation and so on, which I don't know if that's right or wrong, but it's definitely creates less selling pressure in the short term maybe, and so can be a good thing. And then when you talk about launching a token, obviously there's airdrops, which is a difficult thing, because I think it's a great marketing tool, and it's something very unique to crypto. But like any time that sort of you need to, like, no matter how you design your airdrop, some people are going to be pissed off, and so I think there's no way you can do it the right way. So it's very difficult with regards to airdrops. And then if you talk about sort of the long-term tokenomics, so that usually talks about then inflation, deflationary mechanisms, like should I use protocol revenue to buy back tokens from the market? Should I issue new tokens to stakers? If so, what percentage? I think there's no right or wrong here. I think it really depends on sort of the business model. So am I a layer 1, layer 2 blockchain? Am I a DeFi applications? I'm not a big fan of sort of this real yield narrative where sort of you give some money back to your token holders from the revenues that you do, because I think like, now going back to public markets, like companies only buy their own stock if they don't know how to invest the money properly. Like Apple has so much money that they're buying back their own stock because they cannot properly use all this money to fund interesting new projects. And investors demand basically that they buy back the stock. Like a crypto project that launched a year ago and is doing like, I don't know, 20-30 million in revenue, should not use this money to buy back their token, but they should use the $20 million to invest in like new products, because I'm sure they can use 20 million to like pay developers or what's or not. So I think it's a false idea of like giving back to token holders. I think it hurts the protocol in the long term. So maybe there's this one specific thing where I'm not a big fan of. And I am also a big fan of something which I think we'll see more in the future, which is like adjusting token design. So the problem that many companies have is that you need to do this whole token design thing that we were just talking about at a very early point, because as I said earlier, like you're launching your token quite early on usually. But the thing is, at that point in time, you don't know how your business will work like 5 years down the road. So just because I designed my token in 2018, now I'm so much smarter, and I know like, okay, how much revenue can I make? Like, what do people expect from me in terms of staking rewards or whatever? So why not adjust your token after a few years? And I think this is still something where many projects are hesitant to do because it has like a bad reputation. And obviously, like if you issue 20% new tokens, then everyone will say, no, I don't want it to get diluted. But I think people should have like a longer time horizon, and I think it can actually be like helpful to adjust tokenomics. So this is something where I'm a big fan of, which I think is not done properly or often enough today.
Super interesting. Is there anything else to tokens that we haven't discussed that is important for you?
Probably, no.
Yeah, I mean, obviously.
No. I mean, there's so many things, but I think we touched upon many points, and I think maybe just like summarizing, one thing I would say is that as an investor in this market, can be like a professional or just like you buying tokens. You just need to be aware that there are all these different things that influence prices, and it's not as simple as like saying, okay, Bitcoin goes up, my thing should go up, or like it's a good technology that and then my token should go up. Yeah, that's not how the market works at this point, and so one needs to be aware of these things and be careful sort of when you invest.
Cool. If there's nothing else to tokens, I would have a last question for you. Like, why do you think Web3 is interesting, and why should the world care about it?
That's a big question. Maybe let me answer it in. I think there's two answers to it. The way I think about the whole space. So, for me personally, there's like the whole investing angle, and then there's like the fundamental technology, sort of what it can achieve. So, from an investment angle, I think I care, and I think it's interesting because I think there's tremendous growth potential, and I think the market is not very efficient. So obviously, like for me, investing in crypto is easier than like if I would need to create outsized returns in the stock market, just because the market is so much more efficient. I have less of an edge. So it's for me it's quite clear. And that can sound sort of boring and sad if you think about the way you always talk about crypto and this big vision. Now you only say you're in the market because you want to make money. That's one part of the equation. To me, the other part is that I fundamentally believe that a decentralized technology stack can create like very meaningful different products in the long term. And I think in DeFi and in the DeFi and payment space, we're already seeing that with stablecoins and so on. And I'm just like super excited about that. The same thing that drove me into like Ethereum and Bitcoin in the early days is still the same motivation that sort of I read white papers today, and I think it's just like super interesting. But I think we also always have to be critical of our own like thinking, and I do think that we're at the point where we need to prove certain things. Like I think like there's this idea like let's decentralize everything. I don't think that's going to be like a narrative that gets people excited in like 5 to 10 years down the road. I think you need to show actually use cases, products, and so on. So those two things.
Hey, thank you. And thank you for joining us.
Sure.